I told you, on the 12th of March, my video told you guys not to buy Alibaba. Sell Alibaba now and don't look at the numbers. Guess what? The stock price at that time was $226 and now it's $113. Yes, it's dropped 50% since I published that video. Hi guys, it's Eric from Hong Kong based in Germany. I've been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspective about investment, especially related to Asia. So is Alibaba undervalued? If you look at the PE ratio, price to earnings ratio is 17. This is by all standards relatively low, especially comparing with other technology companies. In comparison, Amazon's PE ratio is 67. Yes, more than 3 times higher than Alibaba. And if you look at the profit margins, the net profit margin of Alibaba is 29. And guess what? Amazon is only 4%. Which means for every $100 of revenue, Alibaba earns $29, while Amazon only earns $4. So you can see the value in it. How about growth? Growth has a mixed signal. If you look at the ambition to grow in Southeast Asia through Lazada to a transacted volume on the platform of $100 billion, this is pretty positive. But on the other hand, if you look at the growth forecast ending in March 2022, which is the year-end growth figures, they forecast to have 20 to 23% of growth. It doesn't sound too bad by any standard, but if you compare with their previous forecast in May, which was 29.5%, this is still a significant drop. The lower growth forecast is mainly attributed to regulatory risks. We are talking about anti-competitive behaviors by Alibaba, whether the Chinese government allowed companies to list in the US, and the third pillar is whether the US government allowed Chinese companies to list on Nasdaq or NYSE with certain audit standards. The last part is arguably the most important part but often neglected. The Chinese government's attempt to change capitalist behaviors of people in the country. This would have big implications to us. For anti-competitive behaviors, I believe that Alibaba sees lights at the end of the tunnel. They have already been handed a record amount of fine, but the worst case scenario that the company would be broken up into different pieces did not materialize. So this is a piece of good news. The second part is also that Jack Ma, the founder, has been seen again in public after disappearing for many months, which means that they have already reached a deal with the government. Of course, with more competition being introduced, the market share of Alibaba would not be as high as before. But I don't believe that regulatory risks on anti-competitive behaviors would be a major threat to the share price of Alibaba. How about the risk of whether the Chinese government would allow Chinese companies to list in the US? There are 2 parts. The first part is about new listings, because there's a ban or effective ban on having new VIEs and new listing in the US. VIE stands for Variable Interest Entities. You can check out the link above or in the description below of my video so that you will know what is the VIE. The other part is that existing companies listed in the US using VIE structure. The Chinese regulators try to reassure investors that they will not be affected. Of course, they're concerned, for example, with Didi, which is being forced to delist from the US after only a few months. But this is, for me, is a special case because they defied the order of the government and went on listing anyways. But for the rest of the companies, I don't think that they'll do anything drastic because they raised $2 trillion of capital in the US after all. The third pillar of the regulatory risk is whether the US government would allow these Chinese companies to list in the US. Putting geopolitics aside, we also need to look at the new laws passed by the US Congress and Senate, forbidding foreign companies to list in the US if they do not allow the US regulators to access to their books. But Chinese companies listed in the US never allow the US regulators to access to their accounting books. So this is a really big risk factor for the Chinese companies to be delisted from the US. The fourth pillar of the regulatory risk is probably the one with least attention from overseas investors, but extremely important. The change of culture to remove capitalist mindset from people. You might have heard that there were some crackdowns on celebrities, singers, actors, not only on tax evasions, but also on their behaviors, their personal lives. The latest one is that a fine of 1.34 billion RMB on a top influencer that sells things online. Well, why does it relate to us then? Because this would have big implications to retail sales online. We're talking e-commerce is the biggest part of revenue for Alibaba. If e-commerce is not allowed to sell as aggressively as before, of course the growth figure for Alibaba would be lower. And this would have a short-term big impact on Alibaba's share price. But of course, in the longer term, the Chinese economy needs to move from investment-focused to more consumption as a proportion of their GDP. So in the long term, it should be fine, but there will be a big shock when the government hits on e-commerce. In summary, in terms of growth, the growth is already slowing down, and the new growth engine in Southeast Asia is not going to materialize in a significant proportion anytime soon. In terms of regulatory risks, there are a number of triggers that could harm the share price of Alibaba. For example, the US government could ask it to delist from NYSE or Nasdaq, which is a real risk. And the second risk is about whether the Chinese government would crack down on materialistic or capitalist behaviors on spending, and this would affect the e-commerce platform's performance. Are you guys going to buy Alibaba now, or are you going to wait and see? Leave me in comments below. If you like the video, remember like, share and subscribe. Even better, clicking the bell button next to the subscribe button so that you're not going to miss out.